Friday, it had suspended cooperation with Mali's military in response to the overthrow of President Ibrahim Boubacar Keïta, as thousands gathered in Bamako's Independence Square to celebrate the junta's takeover. Keïta's ousting has dismayed Mali's international partners, who fear it could further destabilize the former French colony and West Africa's entire Sahel region. The United States regularly provides training to soldiers in Mali, including several of the officers who led the coup. A Pentagon spokesperson referred on Friday to the events there as an act of mutiny. But pro-coup Malians danced, tooted vuvuzelas, and welcomed the junta members like soccer stars when they arrived to thank their supporters. We are happy to be with you this afternoon. We thank you for your support. We thank the whole of the Mali people for their support, the junta's spokesman told the crowds. The junta's representatives met with a group of politicians on Thursday evening to discuss how best to move forward and organize a transition to civilian power.
It's Monday, the 24th of August. My name is Kwizera Arnold, coming to you live from Kigali, Rwanda. It's time for Power Lunch East Africa. On the show today, we'll look at investments in the education sector. We also have a chat with the first female CEO of a multinational energy company in Kenya. And how do SMEs bounce back amidst the pandemic? Now, in Rwanda, COVID-19 situation, the country recorded its highest number of COVID-19 cases yesterday in a single day, those being 200 people infected in a single day. Power Lunch East Africa starts right now, but first, your top stories. We'll start off in Kenya, where the total tax receipts in the first month of the financial year fell by 12%, reflecting an environment of depressed economic activity. Now, revenue statistics published by the Treasury Secretary, Ukur Yatani, showed that Kenyan Revenue Authority collected about $876 million in taxes in the month of July, compared with $995 million the year before, the lowest receipts the country has collected since 2017. Moving on, in the Democratic Republic of Congo, Glencore has backed a new alliance to support small-scale cobalt mining in the country, in a move that aims at creating a responsibility-sourced standard to promote the metal's use in electric cars. Now, the Switzerland-based miner believes that the launch of the Fair Cobalt Alliance will encourage car makers to use Congolese cobalt in their batteries rather than engineering it out. Finally, Sudanese and the United States officials have revealed that the United States Secretary of State Mike Pompeo is to visit Sudan in the coming days. Now, the U.S. State Department said that Pompeo will meet the Prime Minister Abdallah Hamdok and the head of its ruling council, General Abdel Fattah al-Burhan, to discuss continued U.S. support for the civilian-led transitional government and express support for deepening the Sudan-Israel relationship. That's all for today's regional top stories. Let's take a moment to look at how the markets are performing. Going by those numbers, you can see the Rwandan franc is still taking a battering. Kenyan shilling has improved there against major currencies. But after 2 years of helping the company with their access to energy program in East Africa, Schneider Electric has tapped Carol Koech to be the new CEO for their East African operations. Now, this makes her the first and only woman, Kenyan woman, to head up that office, but also she becomes the first woman in East Africa to head any multinational energy company. We spoke to her earlier for more on her plans as she takes the helm.
It's a mouthful. You realize that we are in the middle of an uncertain market environment. So at the moment, really is rebuilding our priorities to adapt to the market, and secondly, to ensure that we are stepping in where other people are stepping back, because we also obviously, as much as Schneider is a multinational, we consider ourselves as a multi-local. And we have a big network of partners that help us to ensure our products reach the customers. My priority will be to strengthen the network of partners and to ensure that there's enough coverage. Today, we are probably just focusing a lot only on Kenya, yet our market is large, is East African, where we manage from Nairobi. So priority is to ensure we have enough coverage across the 3 countries. Actually, there are 10, but 3 priority countries for us. And then also the other priority I'll have is to really ensure that the people are inspired to deliver the company's agenda. In the middle of a pandemic, we have somehow managed to overcome globally. If you look at our half-one results at Schneider Electric, we performed better than expectation of the market, and we are resilient. Our products, as you know, largely are automation related, and in this time when everybody is working remotely, it means for us we have a market to serve, to ensure people are able to work remotely, to ensure that they are maintaining and also monitoring their assets without necessarily being physically present. That's really just a high level of the priorities, but I'm sure, in another 2 or 3 months, I will have a clear list.
Yeah, Carol, let's look at you're talking about expansion plans. Electricity as a sector is one of those that is starting to be very competitive, especially with the coming in of the private sector. You're seeing some of your would-be competitors, the likes of Eskom from South Africa, that have expanded into the East African market through Umeme and other subsidiaries they're taking on. Ethiopia is building the Grand Renaissance Dam, where they think they're going to have the cheapest electricity. DRC is also not sleeping there with trying to build a dam there. Now, how do you position yourself in such a very competitive East African market, especially when you're talking about expansion into the likes of Tanzania, Uganda, Kenya, Burundi?
So just to make you understand, actually the names you've mentioned are all our customers. So we offer solutions to them. We're not an electrical provider, but we provide solutions to companies that sell electricity as one of our customers. Of course, we have other customers. So the names you've mentioned are quite exciting for us, because as they grow, we also grow, because we are gonna be serving them.
From engineering to commercial. Now, how do you think that skill set is going to translate into this new role as a head of Schneider Electric's growth and vision strategy?
So the background that I have and the skills I've accumulated are really just consolidating in this role, because being a business leader, the need to understand the solutions that we offer to our customers is important, but also to translate that into a profitable business. So my commercial skills will help truly to ensure we're running a business in a profitable manner, and my technical background will help me to translate the technical solutions we have to our customers and sort of have intelligent conversations with the customers. Obviously, I have a strong technical team that is supporting the different offers that we have in the market. But having an engineering background really helps to have those smart conversations.
When we look at a company like Schneider Electric, it's investing more than 5 or close to 5% in R&D, and that's way above the global average of 1% in research and development. And that means, it steps ahead of so many would-be competitors. What's the interest and your take in development and investment in research and development?
You know, Schneider Electric is actually one of the innovative companies. And when you want to remain innovative and ahead of the game, then you must be preparing yourself for the future. So the investment in R&D is really just to ensure we are ahead of the game, and we are leveraging, the trends in the market, and we're also setting the trends ourselves by developing solutions and new products for the future. That's why we make this huge investment in R&D.
What trends should we look out for moving forward, being that Schneider Electric is leading and is at the forefront of investing in such trends?
So the market trends today globally is really, if you think about it, the world is becoming digital. It's already here. The world is becoming more electric. If you think about the future of motors moving, it probably is moving away from being, gas or oil driven to electric. And more importantly, the world is becoming more sustainable. People want to do things in a sustainable manner. So for us, we are adapting our solutions to these large, mega trends that are happening globally.
And just before we let you go, Carol, look at Kenya and the energy industry there in Kenya, which is quite competitive, seeing a lot of investment moving towards that direction. What's your outlook on the industry and where it's stationed to be, let's say, for the next decade?
So our outlook really is beyond the energy industry. As I earlier explained, Schneider Electric offers solutions both for for energy management and also for industrial automation. So when we look at the Kenyan market, we see the economy being resilient, especially despite these challenges that we are facing now. We've seen the Kenyan economy being very resilient. We've seen a lot of investment in the energy sector. We've also seen investment in industries and large infrastructure projects. So we continue to see Kenya as a strategic market for us, and that we want to grow and embed, and we want to be the leaders in this energy management space as well as the industrial automation.
Carol Koech, CEO of Schneider Electric, speaking to us earlier. Now you're watching Closing Bell East Africa. We'll be right back after this short break.
Honesty and integrity to reach for the stars. We must all get down to work to build a better life for all.
Welcome back to Power Lunch East Africa. Now, at a time when governments around the world are prioritizing the health sector, schools struggle with capital technical resources. We had a conversation with Anusha, the CEO of AV Hub, to talk more on remote learning, edtech, and the COVID-19 pandemic.
Barclays estimated that the spending on technology by educators will increase by 12% in this year, and which is still just 3% of $6 trillion global market. So, given this fact, and after a financing lull in March, investors poured in a lot of money in education sector, catapulting actually several startups past the $1 billion valuation mark. So some of the global startups that I can think of, like Udemy, raised 50 million in February 20, pushing valuation to 2 billion. Applyboard raised 71 million in May. Quizlet closed a 30 million round in May, crossing 1 billion valuation mark. So the overall outlook looks pretty buoyant for education sector.
With all those estimates that Barclays is putting, the ones you've shared with us, like what Barclays is putting out there, some economies on the continent, Kenya, Uganda, Rwanda, South Africa as well, we thought schools would be opening at a particular time. South Africa has opened up schools, but in the wake of that, people in the private sector say schools are getting more expensive. Now, is this something that is going to continue on a monotonous level, or is something that we may see take a few steps back in terms of the costing of education, especially quality education at that?
So education sector in particular, the numbers that Barclays has shared or what the investors are looking at is more in online education as a sector. So what has happened is I think the investment is pouring into online options which are kind of proxy to schools. So to your point, are schools going to be more expensive or any cheaper? Depends on a lot of factors. Are schools going to be safe enough? Are schools looked upon as an alternative for working parents to keep their children occupied? And are they willing to pay a premium so that they have a bit more, they're a bit more hands off from taking care of the children and working from home remotely? So it depends on a lot of factors. But in particular, when I spoke about Barclays Outlook and the funding numbers, it was more on online education or ed tech or education technology as a space.
Let's look about investing in ICT and technology. Most of the countries, especially in the African continent, things like penetration of internet is still way below 10%. Investment in R&D by many, which want to even leapfrog with the likes of STEM education, is still way below the global average of 1%. Now, with schools already struggling with technical resources, how do we bridge that gap?
I think one of the things that's happening is schools struggle with the capital and also technical resources. And this is mostly to do with the absence of government support. Government, in the wake of COVID, is actually prioritizing healthcare sector over education sector. In addition, schools also have a lack of trained staff to conduct online classes. So when you look at all these things, I think the fundamentals. If we go back to fundamentals, then it is so much about can schools raise capital on their own? And to your point, making schools more expensive so that they can then have additional capital resources, channeled into developing their technical capabilities and resources to then able to coach online. So that's one alternative. And second is lobbying with government, asking for grants. Third, and most importantly, is kind of partnering with a lot of startups in the education or ed tech space, which can come up with cheaper technology or better resources or tools which schools can integrate at lesser cost and can scale eventually. But having said that, it still goes back to the fact that the overall internet access for the households or low income family will remain very low. So now then that becomes kind of a luxury for only high end, high income bracket families. And even when we can talk about all the other alternatives, I think the fundamental government support and some kind of subsidizing it or eh, giving grants and things, it's still imperative in my opinion. So to your point, how can school bridge that? The three options that I laid out, they can look into it. But I think it'll be better if schools as a consortium can go and like work collaboratively with government to then kind of look for cheaper resources.
Yeah, I know. This in a way brings about or exposes already shortfalls within our economic systems, our financial systems, our education systems, in terms of the haves and the have-nots. And how don't we think that a pandemic like COVID-19, this Black Swan moment, is just going to increase the divide between the wealthy 1% and the rest of the people from the lower middle class and below?
But that already exists, right? And if anything, pandemic has only amplified that. And if I speak of what's happening in United States, that is so obvious because people at the bottom of the pyramid, they're the first ones to lose their job. They're the first one to be evacuated from their apartment. They are the people who don't have healthcare insurance, and they are the people who inherently also do not have the skills to go into the jobs which gives them, security to work remotely. So that remains, and yes, that unfortunately is the situation right now. And pandemic has only amplified it. What we can hope for is, as the disparity becomes so visible, that the government, private sector, and people in general will join hands to come up with innovative options to bridge the gap eventually. A lot of this kind of reflects on the poor policy infrastructure that a lot of countries have. So I sincerely hope that in the wake of this event, and in the way the disparity is rising, and the way the inadequacies of the policy infrastructure is exposed, governments, democratic governments, and people in general do pressurize government to take remedial measures and bridge the gap.
That was Anusha, the CEO of FE Hub, speaking to us earlier. Now, small and medium entrepreneurs have been the most affected businesses during the current COVID-19 pandemic. So what do they really need to survive? Eric Kaku, CEO and founder of S Partners, joined us earlier for more on that and the African Resilience Initiative for Entrepreneurs that is set to be launched today.
It more than anything else is to think about ways in which they can reinvent their businesses, because I believe that COVID is hitting our economies, our entrepreneurs, and our people in ways that nobody could have predicted a few months ago. So I think what's more important than anything else is to be able to take stock of the situation that they are in. And then once that's done, is to then get the resources in terms of financing and skills required to get the kind of business they need to grow themselves back up. Because I believe that SMEs actually are the first response as it relates to being able to rebuild our economies in Africa post-COVID. So what we are trying to do is to make sure that the SMEs get always the funding and the assistance that they need to thrive, which at ESP we call intelligent capital.
Talk about intelligent capital. When people think capital right now, especially in this moment, people want cash. They want some form of liquidity, and that is hard to come by. We have seen economy recovery funds all over the continent, but it seems to be like they're going to the corporations and not going to those businesses that really need them. Now, many experts are predicting that the economic impact of this on those SMEs, we are far from it. It's going to happen probably in the first half of next year or the last quarter of this year. What's your take on that?
Listen, I think that's actually very, very right, because from the research that we have done at ESP, we've realized that actually about 50% of businesses only have 36 days of cash on hand. What it means is that if you look at what they have on the bank accounts and you compare it to what they spend every day, they can only last for 36 days. If you think about 25% of businesses, they have actually a lot less than that. They have something like 18 days. What it tells you is that a number of our SMEs especially are living hand to mouth. So it's clear that with no injection of cash, many of those businesses are likely to really go bankrupt. So yes, I mean, people are right in stressing the need for SMEs in Africa to get funding in order to restart the businesses.
That reinvention that you're talking about, many are saying, it's going to bring about more collaboration between various industries. You're talking about the likes of restaurants now having to partner with delivery services, and that becomes one supply chain. People are talking about things like hotels, tourism, partnering with the aviation sector to also become, one form of supply chain? Is that the future of industries? Are we looking at a 360 kind of network for industries to be able to survive? And possibly this will be the new normal.
Absolutely. Look, I really think that what's really clear, I mean, if you look at what has happened over the past 15 years, nobody expected that the crisis that we had in 2008 was going to happen so soon, because when that happened, everybody was like, oh, this is a one event that happens every 100 years. So it's going to be a long time since we have something else like that. Now we have like the COVID crisis, which by the looks of it is even worse than what we saw in 2008. So to me, we have to look at those black swan events, which were supposed to happen once every 100 years. Now they're happening probably once every 10, 15 years. So we have to build economies, and we have to build businesses that are a lot more, I would say, like resilient to shocks, like, really businesses that are able to adapt and adjust. So definitely collaboration is going to be part of the new normal. But I think beyond just the collaboration aspect of it, there are going to be aspects around the technology. So how do we use like digital to really change some of the ways in which we do business? I'm pretty sure that for you at CNBC, you are doing a lot more interviews with Skype than you used to like a few weeks ago. I mean, and for somebody like me who used to travel 60, 70% of his time, it's really very different for me to be just in one place in Abidjan and be doing meetings, in 5 to 10 countries every single day. So to me, we are living in times which are different, and they are here to stay. So when things are like that, past the initial shock, what's important is for us to think about how we reinvent ourselves and how do we really identify maybe new opportunities and new sort of markets that can help us grow our businesses. How do we build the skills which are going to help us to fulfill the needs of those markets? And then how do we get the funding to make it happen? Which is why we are launching the program that we are launching today, actually.
Eric, just before we let you go, talking about that program, the African Resilience Initiative for Entrepreneurs that you are leading, yes. What does this entail? Who gets to benefit from it?
Listen, what it entails is a one-in-a-kind, program which targets the SMEs, especially the ones which are led by women. What we are trying to do is to provide them with what we call the intelligent capital. What is it specifically? It's basically three things. Number one, it is helping those SMEs find new markets which they can serve. As a business, unless you have a vibrant market, you can go very, very far. The second thing that we are going to do is to really give them the skills and coach them to serve those markets. So once we've done the two, we are looking then to provide some funding, right? So for us, it's really important to have a holistic solution where we bring those three elements there. So access to market, access to skills, and access to funding. When I speak about funding, I think of funding of up to $150,000 in zero-cost loans for businesses. So for us, it's really important that people keep this in mind. The second thing which is important as well is that the program actually targets 8 countries: Ghana, Cote d'Ivoire, Senegal, Kenya, Nigeria, Rwanda, and Uganda. For us, it was important that the program targets those countries because then we are able to build a community, which is another distinct feature of the program, because often what's being done for businesses, especially the SMEs in Africa, is just for one country within the country, but we felt it was important to help network those businesses to foster the collaboration that we were talking about earlier.
Eric Kaku, CEO and founder of ESP Partners, speaking to us earlier from Abidjan, Ivory Coast. Now, that's all we have for today's show. Feel free to tag us on Twitter, TNBC Africa, using that hashtag PLEF10 or myself at The Real Quizera to join the conversation. You've been watching Power Lunch East Africa. After the break, it's Power Lunch South Africa.
Doctors in most of Nairobi's public hospitals went on strike on Friday to protest against delayed salaries and a lack of personal protective equipment for dealing with coronavirus. Organisers say the strike began at midnight on Friday and comes after Kenyan doctors have posted pictures on social media of what they say is inadequate gear supplied by the government. In a separate incident, police used tear gas against dozens of protesters who'd gathered at Freedom Corner in Uhuru Park to demonstrate against allegations of corruption in the procurement of protective gear. The head of the government-run Kenya Medical Supplies Authority has been suspended over allegations the agency procured low-quality items and inflated prices of others. Matthias Schupeta was among those protesting.
Kenyan government knows the thieves, and it is time they must arrest these thieves. We do not want...
Hello, welcome to Powerland South Africa on this Monday afternoon. We've got ahead of a busy week here, but certainly the good news coming through on the bulletins this morning is the fact that the number of cases appears to be on the decline.
In South Africa, exactly. And it's quite interesting as the US scrambles towards the elections. Donald Trump actually said that he wants to fast-track the Oxford AstraZeneca vaccine trial. But now the FDA says they haven't authorized, they're not in talks. They haven't been in talks for that authorization to use that as an emergency potential vaccine. But we'll see how that goes.
Okay, on the show today, we've got Daniel Maneli, the CEO of ABSA, talking about their results. But first, let's have a look at your top stories.
All right, global food services group Bidcorp has reported huge write-downs in its full-year results as it battles the impact of the COVID-19 crisis. Group sales declined 28% in the last quarter, and it's dealing with big costs such as debt provisions of 785 million rand, restructuring costs of 470 million rand, and asset write-downs of 940 million rand. Its headline earnings are projected to fall by 45 to 50%, and its results are due on the 26th of August.
Now, Famous Brands has reported that it sold its 51% stake in boutique cafe Tasha's. The group has sold its stake to the founders of the Tasha's brand, the Sideris family. Tasha's was founded in 2005 by Natasha Sideris and her brother Sava Sideris. Famous Brands acquired a 51% stake in the group in 2008, which only had 2 restaurants at the time. Tasha now has 18 restaurants in South Africa and 8 in the United Arab Emirates.
Now, insurance giant Old Mutual projects an interim profit loss as it deals with weak business volumes and a spike in business interruption insurance claims due to the COVID-19 crisis. Now, the group expects its headline earnings to be 23 to 33% lower in its interim results, and its interim results will be released on the 1st of September.
Now, this morning, President Cyril Ramaphosa reprimanded his Finance Minister Tito Mboweni for a tweet at the weekend over the firing of Zambia's Reserve Bank Governor, Denny Kalialia. The Finance Minister said in the tweet that President shouldn't wake up in the morning and fire their Reserve Bank governors, and claimed he would mobilize if Zambian President Edgar Lungu didn't give him the reason why. President Lungu replaced Kalialia with Christopher Mvungu, a chartered accountant who was the Deputy Secretary to the Cabinet and a former Africa Regional Head for Standard Chartered Bank. We'll discuss more on this story in depth in our Africa Roundup later in the show with Rydal Marcus.
But before we do that, let's check out your markets.
Joining us this Monday afternoon to discuss the mix of global and market news is Michael Traherne, a portfolio manager at Vestact. Michael, thank you very much for joining us. Interesting moves at Edcon as they plan to sell off part of the business now, as it seems that the whole group appears to be breaking up.
Yes, Chris, great to be with you on this Monday morning, or afternoon, I should say. Yeah, the move from Edcon, widely expected. They were in talks with Retailability already to sell parts of the group. It's worth noting that the parts of the business they're selling, the Edgars, it's not all the stores. It would be the most profitable stores. And I suppose when you're a forced seller, you don't have much bargaining power when it comes to these sorts of things. It's worth noting it's Retailability recently bought Legit, or was it, I think 2017, they bought it from Edcon. So they really understand some of the systems that they will be buying into, how things work beforehand. And the good news here is that staff will be retained. And that's, I think, the main thing here is that, employment levels will not, you won't see as many people retrenched because they're selling parts of the business instead of closing everything down.
Michael, talking about interesting news, Famous Brands has decided to sell its 51% controlling stake in restaurant Tasha's to the founding family. Just walk us through some of the motivations behind this decision by Famous Brands.
So Famous Brands have come out and said that they want to streamline their portfolio. They feel that some of these specialty brands are not core to the business. So as you reported earlier, Tasha's only, was it 18 restaurants that they've got. So it's not massive numbers, particularly when you compare it to the likes of Steers, which is over 2,000 stores. And they're looking to streamline the business. They'll use, obviously, the money that they get from selling Tasha's to pay down some debt. And that's after their very poor move into the UK market, where they've now effectively written down the entire stake in GBK. So yeah, looking to streamline the business, pay down debt, and be a more focused business going forward.
As I said in the intro, Michael, we've got Daniel Mminele, the CEO of Absa, talking about their results very shortly. What kind of questions do you think you'd like to ask him? It seems they're struggling from the top line of the results, that people are struggling to pay back their money, huge impairments on the way. What would you like to know?
Yeah, I mean, all the banking stocks all the banks are reporting similar numbers, so the market wasn't taken by surprise. I mean, Absa is actually up today, even though these numbers didn't look great. It is worth noting, though, that a lot of the impairments are still precautionary. It's management saying, what is the worst that we think can happen, and let's put through impairments of that amount. So it's not unforeseeable that at a later stage you'll see these impairments being written back to some degree. But I think the main thing is what sort of numbers does Absa see going forward? Have they seen any pickup or improvement in credit from South Africans, particularly over August, as things started lifting the economy? So I think that's the main question that I'd be looking at, is how they're seeing things change in the short term.
Now, Michael, Old Mutual released their trading statement today saying that they expect earnings to fall by between 20 and 30%. Do you think the situation in Zimbabwe with the listing on the Zimbabwean Stock Exchange weighed in on their earnings?
Sure. I don't actually know the answer to that question, but I doubt it, and maybe a small part. The bulk of theirs is due to interruptions in business. They weren't able to get new business during the lockdown. And then insurance companies are very sensitive to interest rates, where when interest rates drop, the money that the insurance companies make from the money that's sitting on the side, their profits are a lot lower. So they've been hit with a bit of a double whammy, where you're seeing a weak economy coupled with low inflation, with low interest rates. So that hits them on both sides, and that's where you're seeing this massive drop in earnings. But we'll have to wait until later in the month to see exactly what's going on a business-to-business level.
And a bit of a strange one this weekend, Finance Minister tweeting about the sacking of the Reserve Bank Governor of Zambia. It seems he's been reprimanded by President Cyril Ramaphosa, Tito Mboweni. It's rather odd. I mean, it's probably not going to affect the markets at all, but what's your take on it?
I don't think you want a finance minister tweeting that he's going to be mobilizing, particularly when talking about a foreign nation. as someone who's an economist and who holds the sovereignty of a central bank dear. I mean, I understand the sentiment of where he's coming from, and obviously Tito Mboweni used to be our governor, so he also very much in tune with what's happening on central bank level. The point he was making is that for the stability of the African continent, you need to consider, you can't just fire Reserve Bank governors overnight. That's the point I think he was trying to make, but I don't think he made it very well, and he probably shouldn't have done it in a very public platform.
And just news that came out on the weekend, Cell C saying that they are in the process of job cuts due to their restructuring because they are struggling with a lot of debt. Now, just on that, how do you think, does it look like Cell C actually has the teeth to compete with MTN and Vodacom?
Cell C's one of their biggest problems is they don't have a large network of themselves. So they're reliant on the likes of Vodacom and MTN to get connect their customers. So it's never a great position to be in. And to grow, you need large amounts of capital. I mean, MTN spends over 10 billion around a year just maintaining our network. And that's not small numbers, and it's very difficult for a third player to do that. Cell C is further crippled by the amount of debt that they have on their books. And they've actually, I think they've restructured a few times now where investors have taken a haircut. And unfortunately, when you're in a weak position in an industry that's changing very, very quickly, it's very difficult to keep up.
Thank you very much indeed. That was Michael Traherne, a portfolio manager at Vestac. Going to a short break now. A lot more Power Lunch straight after this.
In challenging times, it is easy to forget what ignited your passion for business. Remember when you were a dreamer, a change maker, a job creator. Recall the promise, the rush, the prospects of success, and the dawn of a brighter tomorrow in the absence of isolation. The new reality of today requires a reboot, a reimagining, and a redirection of ideas. Let's reload opportunities, reimagine growth, renew connections, redirect conversations, regain advantage, revive this economic powerhouse, reignite Gauteng. In us, you have a partner who can open doors, connect you to opportunities, and unlock Gauteng's dynamic possibilities. Remember GGDA.
You're with Power Lunch South Africa, and I'm Chris Bishop. Now, banking group ABSA has reported a drop in interim profits impacted by its 297% increase in credit impairments, which resulted in an 82% plunge in headline earnings. And no interim or full-year dividend is forecast for 2020. Now, joining me for more on the results is Daniel Mminele, the CEO of ABSA. Thank you very much for joining us, Daniel. Now, these impairments... Thank you. And these impairments of the worst case scenario, I understand. How likely is it, you think, that you're going to need the full amount?
Chris, these impairments are based on our best judgment, based on what we know now. As we've indicated, quite a part of it has got to do with management judgment with regard to how we expect the second half to unfold, and some of it has to do with taking into account the high level of uncertainty that still characterizes our operating environment. And there are also issues that have to do with us yet having to get a better understanding on how the various payment relief programs that we've offered previously will pan out. What we have done is to be prudent and to adopt a more cautious approach with regards to exercising that judgment. But I'm very comfortable that we were disciplined and we were prudent in exercising judgment in terms of what we need to provide for.
Now, Daniel, bad loans have drilled a huge hole in your earnings. How do you plan to get out of it?
Well, I think one issue, what one needs to highlight as well, is that obviously these provisions don't equate losses, that these are provisions for possible, potentially expected losses based on our current judgment. So from a point of view of going forward, clearly, as everyone does, we hope that with the economy now being progressively opened up and us getting down to lower lockdown levels, as indeed we've already had some encouraging signs of activities coming back. We are starting to see more demands for our loan products. Applications have been going up in the last few months for mortgages, for vehicle and asset finance portfolios, for example. So our fortunes are very intricately linked with the fortunes of our economy. And so we expect to see some recovery in the second half of the year. But as you know, our overall expectation, based on most recent forecast, is that we will see a contraction, say, in the South African economy, which is our largest market, of no less than 8.3% for 2020.
Well, bearing in mind everything that's happened in the last 6 months in this economy here, where do you think the growth is going to come in your business?
Look, I think it is also important, Chris, to highlight that beyond this number of 82% of our drop in headline earnings, which is quite substantial and indicates just how severe the impact of COVID has been on our business across our markets, given these lockdowns of varying proportions. But I think beyond that, there are a couple of other messages that I think come out of these numbers. For instance, we have seen our revenue growth being quite resilient, and despite slowing significantly in the second quarter, it grew by 3% year on year to just over 40 billion, a quite respectable performance considering the significant sort of pressure that banks have been under during this period. We have managed to contain our operating costs quite well, which have declined by 2% year on year, and part of it having to do with previous actions that were undertaken on a structural basis to deal with costs, but also very disciplined actions, cost management actions that were taken in response to COVID. So the way in which we've responded to the crisis, the way in which we've migrated to different ways of working and entrenching remote working models, optimizing our cost base should put us in good stead when the economy recovers. And we obviously continue also to have healthy capital and liquidity buffers.
Now, Daniel, Absa had taken a stance of preserving cash rather than gaining market share. I'm just interested, as economies are opening up, are you still going to implement that defensive stance? Is there going to be more aggressive lending?
Well, what we have said is that we will temporarily hold in abeyance our growth ambitions as the current environment, the current economic climate requires us to focus on preserving capital, making sure we've got sufficient liquidity buffers, and these cost management actions I was just talking about. That does not mean that that is to the exclusion of continuing to support our clients and our customers, even within that framework. So we haven't closed shop. We continue to support our customers, and of course also we understand our responsibility as a business to contribute to the role that we need to play in the country in supporting the economy at this point in time.
Thank you very much indeed. That was Daniel Mminele, the CEO of ABSA, on the company's results that show an 82% decline in normalized interim earnings. Now moving on a bit further afield, global ratings agency S&P has affirmed Zambia's long and short-term foreign and local currency sovereign credit ratings with a negative outlook. But this news was overshadowed by the surprise move at the weekend by Zambian President Edgar Lungu over the weekend, as he fired the Reserve Bank governor with immediate effect, and for no apparent reason. And as you probably heard in the news earlier, there was a lot of controversy about that. Tito Mboweni tweeted about it, and he's been rapped over the knuckles this morning for doing so by Cyril Ramaphosa. But joining me to unpack more on this is Rydell Marcus, an Africa strategist at ABSA Corporate and Investment Banking. So Rydell, thanks for joining us. A lot of controversy over the weekend, which continues into Monday morning with Tito Mboweni. How are you reading, just go back to the start of this story, how are you reading this dismissal of the Reserve Bank governor in Lusaka?
Thank you very much, Chris. Good afternoon. Yeah, of course, you're right. I mean, the S&P affirmation of Zambia's rating was completely overshadowed by this. This was completely unexpected as well. And it was unexpected because Governor Kalalia was appointed in 2015, but his contract was renewed in 2018 as well, and was meant to only be concluded or end by 2023. And as far as I'm concerned, and also the market seems like he was very well respected. He did his best to, under very difficult circumstances, to bring inflation under control. Of course, inflation has risen way above 10% in recent months. But despite that, despite the fact that inflation is close to 16%, he has delivered nearly 350 basis points of cuts this year alone, with the last cut actually coming just last week when they cut the policy rate to 8% by a full 125 basis points. So he certainly worked very hard to try and get the economy going again, to get liquidity to be increased and credit to flow. And it's therefore a bit of a surprise that that he has been replaced. Of course, his replacement, Christopher Mavunga, he himself is fairly experienced as a former finance minister, a deputy finance minister. He was also in control of the finance and economic development portfolio, where he was deputy secretary to the cabinet, and a lot of experience in commercial banking. But even with all that experience, I think just seeing all the criticism coming through over the weekend and this morning, that everybody was certainly surprised and a bit shocked that Governor Kalalia was replaced.
Rydell, I hear that the new governor does have a good track record in the financial industry, but is he a Reserve Bank governor?
So, yes, I mean, Governor Mavunga, as I said before, you know, he was deputy finance minister. He was in control of the finance economic development portfolio. He worked at commercial banks where he took on various portfolios, from raising capital to being in control of the African sort of region for one of the banks, etc. So he certainly has got a lot of financial market experience, and also very politically connected, given his experience within government. So it is difficult to say, just because he hasn't worked specifically in the central bank, that he is not the right person. I certainly believe that he's got all the credentials to make it work. of course, there will be a significant amount of pressure on him. One of the issues is the distribution of the stimulus package funds. The disbursement of those funds needed to be spread up. And that has been caused by small businesses who were very frustrated by the sort of stringent measures on accessing those funds. That is an aspect that he must give attention to, but he will also be put under pressure to get the economy back on track, at least by stabilizing the exchange rate, get credit going, as I mentioned before, contain inflation and bring inflation back from the sort of 16% levels where it is currently to within the target band of at least 6 to 8%. So he's got a very tough task ahead of him, but we remain hopeful that he will succeed.
I'm afraid that's all we've got time for on this Monday afternoon. Thank you very much indeed. That was Rydell Marcus, an Africa strategist at Absa Corporate and Investment Banking. And that's all we've got time for here on Powerline South Africa. But stay tuned. After the broadcast today, we'll bring you a live Gautrain broadcast next with Gauteng MEC Tasneem Mutara. She'll be speaking to my colleague Godfrey Matiswa. Anyway, we shall look forward to seeing you again tomorrow, same time, 12 o'clock, Power Lunch, and we'll also be back for an update this afternoon and closing bell.
Right, from us, it's goodbye for today.
Goodbye.
Marco is 60, plans to retire at 65, and has 7 million rand in a preservation fund. What would happen if he switched to Outvest? With Outvest's revolutionary one fee, he'll pay up to 90% less than with some traditional investments. And with performance of selected funds comparable to their competitors, Marco could get over 1.3 million rand more when he retires. Go to outvest.co.za or SMS OUT to 32337 and we'll call you back.
From a tourism sector perspective, we have consolidated, put together with the industry and the sector what we deemed as a recovery plan for the province. If one considers the contribution of tourism in the province from a GDP perspective, you're talking about 18%, which translates to about 67 billion, seriously affected. One of the things that we have been acutely aware about it is that we need to have to box cleverly in this. So it's a smart marketing messaging, encouraging supportive messages to the general public so that people do not forget about the wonderful offerings that the province has to offer. So we've been planting messages in all the social media platforms so that people are able to keep in mind about the hidden treasures and the jewel that the Eastern Cape has to offer.
The leaders of 15 West African states are sending a delegation to Mali in the hope of restoring order amid the military junta that overthrew that country's president this week. And a coalition of opposition political parties have joined the armed forces in rejecting any foreign interference to the ousting of Ibrahim Boubacar Keïta. Cheikh Oumar Sissoko is a leader in the opposition coalition.
Ils veulent venir, ils viendront.
They want to come. They will come, but we won't move.
Welcome to this episode of How Train While It Matters. I'm Godfrey Mutizwa. Now, we all know the importance of infrastructure development. We want in particular today to focus on the impact that they are having in Gauteng and also talk about the province 5-year infrastructure project pipeline to revitalize the economy and the contribution of projects such as the Gautrain and the impact they have on economic growth. My guest for this conversation today is the Gauteng MEC for Infrastructure Development, Tasneem Motara. She joins us now. MEC, thank you for your time and good to see you. These are uncertain times.
Yes. Good afternoon and thanks for having me.
I think let's begin with the main theme that we want to tackle today, which is the issue of socio-economic development and the kind of strategies that you have in place to ensure that you actually have measurables that you get out of these infrastructure projects. Let's just begin perhaps by explaining to us, number one, the definition of it, and then secondly, let's talk about the strategy that you have.
Okay, really. So the definition of the socio-economic impact and the strategy aligned to that is really about how can we, especially now post-COVID or with the regulations easing up, how can we re-engineer and reignite the economy? Given the fact that our socio-economic status has definitely changed from prior the pandemic to now. So you have a lot more pressures on jobs, on the creation or the ability to create jobs, but also just the ability to earn an income, start a business, etc. So really our strategy as a province and provincial wide has to look at what is it that is the state has as an ability to be able to catalyze and open up a lot of the economic opportunities that are there. We've identified that infrastructure amongst many one could be and definitely are one of the key drivers of that socio-economic change and revitalization that we're looking for. To this end, we're looking at infrastructure of various kinds, and I know that we're going to speak about Gautrain and just really the rail and transportation space in the province. And over and above that, it would also mean just social infrastructure, like the continuation of building of schools, improving health facilities and the like.
Yeah, it's important, of course, that these things are measurable, and we're going to talk a little bit about that. But I wanted to know if you have had to rethink your socio-economic development programs in the light of COVID-19 and what impact it has had on it.
I think for us, it was not really about rethinking. I think we've really agreed on the approach, but it was about how do we accelerate it. Some of the things that we wanted to do maybe in year 4 and 5 actually need to be brought forward in year 2 and 3 for us to see a real impact. The situation is dire now. If we thought we were in a bad situation in January, we're even in a worse situation now. And so long-term planning, we really can't afford it.
Yeah, I guess the second part to my question is whether you have had to change some of the targets that you wanted to achieve in terms of your socio-economic development program, and whether COVID has forced you to reduce resources in one part to transfer them to another part.
Yeah, so COVID really forced us all to reprioritize. So reprioritization, looking at what we would like to do versus what we have to do, becomes very, very critical. And then what are the trade-offs we are willing to make? So, for instance, NHI is the policy of the leading party, the governing party, and for us to implement NHI, a core part of that is the infrastructure that's responsible to be able to cushion and support the rollout of NHI. And of course, NHI would have been a very long-term plan, but a lot of what we had to do in terms of even just responding to COVID would have seen us bring forward a lot of plans in line with just the NHI deliverables. So it's about making those delicate trade-offs, but making sure that reprioritization in the wake of what the pandemic has done to the economy.
Yeah. So I and a number of our journalists were part of the conversation that the president had with the country a few, maybe is it a month or a couple of months ago, where he talked about the importance of infrastructure and its role in trying to regrow the economy and get the economy to move again. And the emphasis, as you will recall, was that infrastructure is going to lead us out of this. And my question to you is, in Gauteng, I would imagine there would be a large chunk of that program that the government is targeting in terms of projects. Can we talk about those, please?
Yes, almost definitely. So we have concluded what we call the 5-year project pipeline. And I think there was an opportunity just before the lockdown. We were able to share it with partners in the private and as well as the public space. So we've consolidated a 5-year project pipeline. So really, what does that do? So it gives confidence to the private sector to be able to see what are the plans of government. Secondly, it also gives confidence to investors who want to really invest, and then they able them to see what are your future plans. So we're not really planning sort of a knee-jerk reaction way. And then what we've done is packaged a lot of the projects that the fiscus would not be able to fund and would need private partnership to be able to fund. But also we've been able to demonstrate what government, and in this instance, provincial government in Gauteng, will be putting down as our own investment. So of course, to attract investment, government has got to be able to show what is it that they are putting from their side. So we've been able to say that over the next 5 years, we are confident that we're going to put 60 billion towards the investment of infrastructure in the province. Included in that, of course, is a lot of social infrastructure in the main, but also we've wanted to lean on the maintenance of our infrastructure. And of course, because we've got historical challenges, yes, we could go into the details of why we've not budgeted adequately and accurately for maintenance, but it's something that we've got to do. So we've skewed a lot of it towards maintenance from our own budget, but we've got a fairly comprehensive view of what it is that will be rolled out in the province in the next 5 years.
Yeah, you know what the naysayers will say, of course, the ANC is very good at talking. It's all talk. It has been talk since 1994. I wanted to talk about timeframes in terms of which some of the key projects that you are looking at are being planned, and also whether you have seen any movement since that symposium that we had and where we are today.
Yes, so just from the top of my head, I can tell you about the 10 hospitals that we are going to refurbish and just upgrade them. Some of them we were able to upgrade using the COVID response. So the 10 hospitals out of 32 hospitals have been identified as priority hospitals. We're starting with the ones out in the West Rand, particularly. So those are 4 hospitals. They are due to start at any given moment. They've gone through the public bidding process already. The next are the hospitals in Tshwane. Those have been identified as priority. So, but also what we were able to do with the reprioritization and the alignment of what COVID had forced us to do, and also just to readjust our 5-year pipeline, we were able to then merge the two, the 5-year plans in the health infrastructure projects, and then say, okay, we had, for instance, a long-term plan for the upgrade of Dr. George Mukhari Hospital, as an example. A lot of that work we were able to do now in the past 3 to 4 months. By the end of October, we would have handed over the hospital beds in the facility, and then with an additional 300 beds using alternative building technology. So We've got the 32 hospitals in the province. We're starting with the 10. Some of them have also been addressed now in the COVID process. The others is then, of course, the rapid rail integrated network extensions. And I know that's a mouthful, but everybody understands them to be the Gautrain expansion. And of course, I think what we are happy about, and it's also something that the president would have spoken about, is National Treasury's appetite now to approve triple Ps. So we have, for instance, found that in the past, Treasury would have been a bit reluctant to approve triple Ps, and that's the public-private partnership model of financing key government infrastructure. But because the reality is that the fiscus can't fund all of these, we've got to look at the private sector to be able to partner with us.
Yeah.
Particularly in the province, we're looking at the Kopanong project that's also on its way to closure in terms of the request for proposals in line with the triple P process, and that's going to see the 15 buildings in the provincial government in the CBD being completely overhauled, revamped, and that's going to give the CBD, the biggest CBD, which is the Johannesburg CBD, just a new lifeblood really for the next 30 to 50 years in terms of investment, but also just in terms of the changing demographic in the CBD. It's no longer the central business district that we know and we grew up knowing. Yeah. It's also changed to accommodate students. It's also changed to accommodate housing needs, and working with the municipality, we're able to direct those changes and look at bringing in private funders with very good deep pockets, but who are able to also share the risk with provincial government to be able to capitalize a lot of these economic opportunities.
Absolutely. MEC, you don't know how happy you are making me, because you know what they say when, in fact, I see it when I travel as well around the continent. If you want to see how well a country is doing, check its hospitals and see how it treats its people. In many cases, what you see is dilapidated infrastructure, and it would be really, really amazing if we're able to see those 10 hospitals that you say are going to be transformed out of this. We must, of course, talk about the elephant in the room, MEC. I mean, we have seen what has happened within the health sector for the PPEs program, the corruption that is followed that program. And people are going to say, oh, with infrastructure, you know, the amounts that you're talking about with PPEs is going to be small change. We're talking billions and billions of rand. Let's talk about your strategy to tackle, in particular, or prevent the emergence or perception of corruption within this program in order to get the buy-in that you require from citizens.
Yes, look, I think we are in a very precarious position because perception does play a big role in what the public sees as what government is doing. The provincial government has introduced a lot of measures to be able to improve on that perception and ultimately improving on the reality. So, for instance, the open tender system. Of course, in an emergency, we don't make use of the normal procurement processes. There are a lot of deviations, which are allowed for in law. Sure. But I think importantly is that with the rollout of the 5-year infrastructure program, we've got to be able to be very meticulous in terms of adhering to the law. We've got to not work alone as a provincial department, or any provincial department can't afford to work alone. So for instance, on Kopanong, we work very, very closely with the municipality as well as National Treasury and Provincial Treasury to make sure that the checks and balances are there all the time. We've even begun to speak more frequently to the Auditor General, just to make sure that we are on the right path, that we are making sure that we're crossing the T's, dotting the I's, because the problem is that you can go out on a very aggressive procurement process and a procurement strategy, but what happens post almost just dilutes what you want to do in terms of economic investment and injections. Yeah. For instance, with us, just as the Department of Infrastructure, we were able to, through the process, appoint just over 52 different companies to be able to assist us with the response towards COVID, and adhering to the Treasury regulations, making sure that the Auditor General is happy with our processes, because I think the public want to know that the process was clean and above board and open for anybody to scrutinize and be accepted. I think we've got to just accept that the ailing economy doesn't help our situation either.
Yeah.
There are companies who definitely want to do business with the state and who should do business with the state because they qualify to do so, and they qualify to do so because they qualify to do so on merit, not because they have connections or they know somebody who knows somebody who knows somebody.
Yeah.
And I think that the difficulty is that the private sector says, look, we've got capacity, we can do this work. But when you bring people who are really not in business or don't know how to do this work, it really says a lot about just government processes.
Yeah.
So as far as possible, we're not going to enter into an emergency process with any of these procurement. That means that we've got to have planning in place, human resource capacity to be able to achieve those targets. And I know that the Department of Transport is working extensively to be able to put those in place, as the Department of Infrastructure as well, making sure that human resource capacity is beefed up, but also just being able to make sure that you plan end to end, from the procurement process right down to handover, to make sure that your process is clean. Anybody who feels hard done by can come in, understand why it was that their bid didn't make the cut as opposed to person X. I think those things are very important for the private sector.
Absolutely, and you're absolutely right that perceptions play a large part in some of the tiring that you see of all government work by people who sit outside. We tend to forget, of course, that the Gautrain itself was a partnership between the state and the private sector. It is a shining example of what can be done when people go about these things and do them properly. So I want to take you back to the Gautrain and the expansion program that you spoke about. We are all waiting on tender hooks. You don't need to sell the Gautrain to me. I'm a big disciple. My question is, what's keeping you from moving even faster than you are on that expansion program, and where are we in terms of that?
So in terms of where we are with we've done all the necessary in terms of getting the approvals from Treasury. So like I said, because it's a typical triple P, private-public partnership that must go through the Treasury processes, it's also got a lot, so you've got to give, for instance, Treasury alternatives, different alternatives. It's got to include a whole lot of environmental screening, as an example. So you've got to look at conservation status, whether your ecosystem is going to be threatened, what happens to municipalities. You've got to go through extensive public participation. And I know that on the Gautrain, at least there, we have a lot of buy-in from the public because it has big uptake. We've also got to go through a whole lot of processes that are legislated, but that have to, and for compliance sake. So any part of the process that you miss is that then just can throw out the entire process, and we don't want to have that. We don't want to like get to the end and then get somebody who says, oh, but you didn't do X, Y, Z in the process, start again. That's going to put us back. So we're really very, very meticulous. We're now just on the process of the extension in terms of the routes, where we are. So the route process, I know, would have gone through various changes. What we wanted to have as an extension, what came back, had to also go back to say, no, the problem is that we want to integrate the network with and have really a holistic integrated public transport system. So that's where we are now. And I think the next steps for the project is to be able to conclude all of those processes between ourselves and the different stakeholders, the different to report to the legislative and the regulatory bodies that need those reports for funding, especially National Treasury. And then we'll get, once we get the final approval, gazette the route for the phase 1 extension, we can then go on and go ahead. I don't want to put my head on the block and say how many days it's going to take, but we are quite far in terms of that process. So, and like I said, Treasury has come on board with the passion from the president, definitely, to say that triple Ps need to be approved, because there are private partners who say that they do have funding. Your approval process as government sometimes takes too long. If you take too long, we'll shift our money elsewhere where we have projects that are ready. And Treasury has definitely come on board to say, okay, let's look at your triple P proposals, your public-private proposals, and let's look at what can be approved from Treasury's side so that we can get them going.
Absolutely, and I can imagine the public will say, take your time as much as you can, MEC, as long as you make sure the process is clean. But at the same time, we want those trains yesterday, so you can't really win, can you?
No, but I guess that's in the nature of our business.
It is. That's why you get elected. That's why you are public servants. I wanted to talk to you a little bit about the appetite that you have been able to gather, if you have indeed been able to talk to any of the private sector players that potentially would be partners in these processes. Have you seen any appetite from them? And you know, in these big projects, and also just in terms of the person that you're dealing with, you see their interest, obviously the expression of interest, but it's also what they charge you in terms of risk. You will see how happy they are to partner with you. What are you seeing in terms of interest?
Look, each project, depending on the return on investment, would attract the necessary interest from our private partners.
Right.
So we've gone through. So what we do is really package a proposal for the private sector and present it to them. Tell them, look, this is the financial benefits. This is the contribution to the GDP that you will see. So, for instance, just on the phase one, which is what we were speaking about on the Gautrain extension, for the next 20 years, you're looking at 113 billion rand in worth of financial benefits across the board. So that's just it's materials, it's manpower, it's job creation, and that sort of thing. We're looking at 110 billion rand GDP contribution. That's also just over the next 20 years. Just for the GDP of Gauteng, we're looking at a 78 billion rand contribution just on our internal GDP. You're looking at the benefits of job creation for the next 20 years. We're looking at just over 320,000 for 20 years. And so those are some of the numbers that we give investors. They do, of course, some would be very aggressive and go for high value projects such as the Gautrain. Of course, we've been able to look at the first Gautrain rollout, and of course, there's valuable lessons that we've learned. You would remember that with the Gautrain, the Gautrain as we have now, we had to import a lot of expertise, from jobs to professionals to a lot of expertise had to be imported. We're not at that phase now, no longer. We can really roll this out with the expertise available in the country. So if you have to quantify it, I think we can quantify it per project. Yeah. Projects that we think these definitely need private partnerships, and the private sector is definitely, if they can see value for money and the return on their investment quite clearly with no sort of gray areas, and if you're able to even respond to questions that they have, you find that the private sector is willing to invest. I mean, anybody wants to, those in the private sector, they live to invest their money to get a return. Yeah. And if you can demonstrate that as government, that they will definitely receive a return, and demonstrate it in rands and cents and how it's going to affect their bottom line, they're fairly happy to partner with us.
Yeah, and a key consideration in these projects, of course, is sustainability, the ability to ensure that post their construction, they don't become the proverbial white elephants, and you are able to generate sustainable returns on them to the extent that they are able to be kept in operation. What measures are you taking to ensure these will be obtained as you implement these projects?
Yeah, so for us, I think that's where we make the decision of what to take out to the market, to the private sector, for partnerships, as opposed to funding them from the fiscus. So for us as government, the social infrastructure remains our responsibility. And of course, you would know that some schools have a lifeline, and then communities change and we've got to close the school. So you wouldn't want to have that type of a partnership with the private sector, unless, of course, for instance, you're rolling out schools of specialization, or schools that are linked to a private sector, or to a particular private sector. So the social infrastructure will still keep those as part of our investment book, because of course for us it's about the social benefits that you can't necessarily count in terms of rands and cents, but you can count in terms of social benefit, just human abilities and human improvement, the life of human beings. And then there are others that are for social benefit, definitely, but have a direct impact on the bottom line of investors. Gautrain is one of them. The Kopanong precinct project, which I spoke about earlier on, is also one of them, where we're giving 15 buildings as in a phased approach that is clustered to the private sector to really own for 30 years. I mean, that's quite a lucrative deal, as opposed to building a clinic that you've got to really fund out of your pocket in terms of maintenance and even the construction thereof. So we look at those and then decide which ones we take to the private sector. There are going to be some social infrastructure projects that we will also take out to the private sector. For instance, just looking at the health space, because there's a lot of private players in the health space, to be able to say that, look, if you invest, this is your return on investment in terms of what you could benefit out of it. But again, knowing that, of course, the state subsidizes health in South Africa to a large, almost 100%.
Absolutely. It's key, of course, that we build these things, but what is even more important is what you spoke about earlier when we started this interview, where you spoke about the amounts that are being set aside for the maintenance of these projects. Just give us the planning around that and your ability to get the support that you require from Treasury to be able to maintain these facilities, because often we know they are happy to pay, but once they have paid, to then come back and say, we need more money for that building to be maintained, sometimes that conversation falls on deaf ears.
Yes, so I think, unfortunately, which is it's something that we've done incorrectly in South Africa, was that we would have funded infrastructure projects in terms of greenfields investments. However, when a decision must be made about where do you take money from and move it from A to B, you ultimately move money earmarked for maintenance to another pressing need. What this does is that it devalues the investment that you would have made on a greenfields project. And then when you actually have to reinvest, you're reinvesting into the project as if starting from ground zero. And then, of course, a lot also has to do with the internal ability of each department to be able just to manage its own internal finances. So, for instance, I mean, if we think about the Department of Health, for the larger part of the last administration, the Department of Health actually took away money from infrastructure to deal with their accruals. A necessary decision. I mean, they had to make sure that they deal with accruals because that has a negative impact on the department's ability to perform. But what it does at the back end is that it takes away from what you could be investing in infrastructure. So when we look at triple Ps and when we're looking at public-private partnerships and to get Treasury approval, there's actually a big part of it that speaks to the investment and the costs for maintenance over the concession period. So you've got to build those costs in, and only then really will Treasury approve it. I think we've got to get to a point, even as a state as a whole, to say that there are non-negotiables that we've got to enter into where we can't move money. So you can't really shift. You shouldn't be shifting money from maintenance to deal with accruals. I think that's just bad planning. I think it's also just it's just unfortunately things that we've also been inherited historically from past performances of departments. But fortunately, the Department of Health has been able to deal with many of their accruals, and we don't foresee them being forced into a decision where they say, look, we can't maintain anything anymore. We've got to shift money from infrastructure in terms of maintenance to another pressing need.
All the best, MEC, in that battle. We wish you well. And I wanted to say to you, yes, of course, there is social distancing in place now. But in our studio, I can tell you we are okay in terms of our physical distancing. So don't be shy in popping up into the studio. Thank you for joining us this afternoon.
Thank you. Yes, I'm sure now with level 2 we can. I look forward to it.
Thank you very much. Gauteng MEC for Infrastructure Development, Tasneem Motara, joining us for this edition of the Gautrain Why It Matters, where we speak about the signature project that has absolutely transformed Gauteng into a modern-day province, as well as, of course, the city of Johannesburg and Pretoria. Thank you for joining us today. Until next time, goodbye.
Doctors in most of Nairobi's public hospitals went on strike on Friday to protest against delayed salaries and a lack of personal protective equipment for dealing with coronavirus. Organisers say the strike began at midnight on Friday and comes after Kenyan doctors have posted pictures on social media of what they say is
It's Monday, the 24th of August, and you're watching Power Lunch West Africa, where we examine some of the top stories that impact the finance and business world across West Africa. I'm Kenneth Igbomo, and thank you so much for joining me on the show today. Coming up on Power Lunch West Africa, Nigeria's second quarter GDP contracted by 6.10% year-on-year. We'll get into the details on the show. Still on Power Lunch West Africa, CEO of Tolaram Group West Africa joins me to discuss how they're adjusting to the new normal caused by the COVID-19 pandemic. You can join this and all conversations on the show. Join us online. The hashtag to use is PLW410. You can also hit me up on my handle, that's at Kenneth Igbomo. But first, let's take a quick look at some major headlines making rounds across West Africa at this hour. Now, Nigeria's second quarter GDP figures show a 6.1% year-on-year contraction in real terms, ending the three-year trend of low but positive growth since the 2016 and 2017 recession. Nigeria's National Bureau of Statistics says the decline was largely driven by COVID-19-induced drop in domestic and international economic activity during the quarter. Second quarter of sector figures for the period show a decrease of 13.8 percentage points relative to Q2 of 2019. Now, negotiations are slated to continue today among mediators from West Africa's regional bloc ECOWAS and Mali's military junta over plans to return the country to civilian rule. According to Nigeria's former president Goodluck Jonathan, who leads the ECOWAS mediator delegation, both parties have been able to agree on a number of points. A spokesman for the military junta, Colonel Ismail Wagwe, also said compromises were reached on certain aspects. Moving on to Ghana now, Ghana's tourism authority has introduced final COVID-19 health and safety protocols for the country's tourism sector to guide the reopening of tourism-centered businesses. The guidelines circulated across hotels and restaurants exclude the opening of casinos and indoor drinking bars whose operations are still embargoed by the government. CEO of Ghana Tourism Authority, Akwasi Ageman, says the guidelines will offer a conducive atmosphere to safely conduct business even within a pandemic. Now, on to oil. Now, all crude oil prices rose in early trade today as storms closed in on the Gulf of Mexico, shorting more than half of its production. Also, signs of progress in development of COVID-19 treatment is having a positive impact on prices in the market. Brent crude was up 32 cents to $44.67 a barrel, while US WTI crude futures rose 31 cents to $42.65 a barrel. These are some of the top stories that we're tracking across the region. Now, data from the National Bureau of Statistics shows that a 6.1% decline in Nigeria's second quarter GDP in real terms. And I have Johnson Chukwu, the CEO of Kari Asset Management, and Bismarck Rewani, the CEO of Financial Derivatives. It joins me now to break down the numbers. Thank you so much for joining me on the show today. And let me start by getting your thoughts on these numbers that we're seeing so far. Let me start with Johnson and then get to Bismarck.
Well, thank you for having me or having us. The numbers we are most expected, as we all know, the economy was locked down for the 3 months of the second quarter of this year. The Nigerian economy was actually locked down on Lagos, Abuja, and Ogun State. We are locked down on 31st of March. And we saw a period of 3 months where there was virtually, the economic activity was at standstill. So there was anything other than what we saw would have been unexpected. So I had expected that we should see a contraction in the GDP in the second quarter of this year. Nigeria is not the only one that is facing similar GDP contractions. We are seeing almost all the countries that published their Q2 GDP figure contract with the report that showed that the economy is contracted.
All right, Bismarck, let me get your thoughts on this.
First and foremost, the economic disruption, both for supply chain disruption and slowdown in demand, had started globally since the first quarter. Well, if you take the cumulative contraction in economic activity First quarter 1.87 plus minus 6.1% in Q2. You have a cumulative contraction in economic activity of 7.97, which comes to an almost equivalent of 12 trillion naira. When you look at this and look at it in the context of how much we have for the economic sustainability plan, which is 2.5 trillion naira, which is about 2% of GDP, you will find that the cumulative contraction year to date is about 12 trillion naira, which is the equivalent amount of the budget for 2021. So what has happened is that there's a lag between when you slow down and when you feel the effect. And so, yes, it was widely expected, but again, could it have been better? And should they have done certain things to have reduced the impact? So Q1, Q2, we are minus 6.1. Q3, which is ending in another month, it's going to be worse than 6.1. So technically, we're in a recession. How severe is this recession, and how long will it last before you come out of it becomes critical, and what steps have to be taken immediately to reduce, one, the impact of the recession, and two, the length and duration of that recession. That's what we should be focusing on right now.
All right, definitely quite a lot to ponder on, talking about the severity of this contraction and the ways out. But Johnson, let's get your thoughts on the possible fiscal and monetary responses we can expect.
The federal government of Nigeria has actually come up with what they call an economic sustainability plan, where their plan is to inject about 2.3 trillion naira into the economy. And the expectation is that with just 2.3 trillion naira injection, the economy will only contract by 0.59%. If you look at the H1 2020 GDP performance, cumulative GDP performance, we actually have a contraction about 2.12%. So in effect, for you to have a full year contraction of just 0.59%, you're going to have second half of this year should have a positive growth. And just like Bismarck said, that might be a tall order for one to expect. So in terms of the fiscal authorities stimulus, even the 2.3 trillion naira that is provided under the economic sustainability plan, more than 1.15 trillion of that is coming from the monetary authorities intervention funding. The portion that is supposed to come to the fiscal authorities are less than 1 trillion. But most importantly, if you look at the budget as an instrument for stimulating the economy, the budget will be constrained by funding gaps. We're already seeing a lot of funding stress on the part of the fiscal authorities. We've seen oil price has remained below $45 per barrel. We know our crude production, based on the current quarter, is just about 1.4 million barrels. And if you look at other revenue sources, tax revenues, revenue from independent sources, government agencies, SOEs, we're also seeing a decline in revenues from virtually all the income heads. So it's going to be a tall order for the government to stimulate the economy from fiscal side. The monetary side has a limit to its ability to continue to expand liquidity by ways and means, by quantitative easing. So I think in terms of intervention, the government is actually highly constrained because we do not have the reserve to support intervention from our existing reserve. And we're already seeing the liquidity expansion bringing a lot of pressure on the foreign exchange rates. We've seen Naira move to close to 500 Naira to a dollar, about 490 Naira to a dollar in the parallel market. Part of it is, one, a desperate need by foreign portfolio investors to exit, and also the fact that we are expanding liquidity in the economy without commensurate increase in productivity. So this, in terms of what the government can do, government is highly constrained by, one, its capacity to raise funding for the budget, and two, the limit to which monetary interventions can support economic recovery.
All right, Bismarck, still on policy response, we're seeing that COVID-19 is coming now to wipe out the recovery efforts we've seen since the last recession. And I'd like to get your thoughts on the importance of building a structurally resilient economy with our response plan.
First and foremost, COVID only worsened a bad situation. The economy was anemic before COVID. It was already slowing down. What you had in Q1 was a lingering spillover of Q4 in certain sectors. Look at our 5 trading partners, all of them, China, India, the United States, UK, and EU, were all facing difficulty in February and March. So the fact that you had some spillover into Q1 and the 1.87% growth you got in Q1 was just an anomaly. The reality today, and Johnson mentioned it, the limitations of fiscal policy are there. The limitations of monetary policy and the heterodox policies, which on one hand, it's creating more, at times creating more difficulty. So let's step back a little bit and decide on one thing. The national income identity equation says that there's government, there's investment, there's consumption, and there are net exports. We can't do anything about net exports. We know that our exports, today the price of oil is higher than what it was in Q2, and also the demand for our imports has also reduced. So that can take care of itself. The only way to go out of this is to increase productivity. Productivity means that those companies and those factories that are victims of forex rationing at this time by the central bank need to get back to work. So what do we have to do? We have to adjust our exchange rate by unification, 1. 2, we've got to sell forex to these guys so that they can produce, and that will help bring down, 1, inflation, create employment, and create output growth. While doing that, we structure some of our debt obligations, international debt obligations, in such a way that we have some breathing room to do that. All of these policy responses put together, and more than anything else, you'll find that investment, which is the key variable, has not been addressed. The ESP, which is 2.3 trillion naira, is extremely constrained. It's less than 2% of GDP, and yet you're having a contraction of total contraction of 8% of GDP, which is about 12 trillion naira. We must do something to the other variable is how do you get domestic and international investment to step up to the plate by giving them all the incentives, match funding, tax incentives, and all of this is to bring it back, to bring them to the party. We cannot do it. We cannot do it government expenditure. We cannot do it with heterodox monetary policy, because we now have what we call a quadrilemma. Quadrilemma is you have 4 unpleasant options, 4 unpleasant variables. 1, negative growth, which is a recession. 2, high unemployment. 3, weakness in the currency. And 4, we are talking about inflation. So when you take all of these 4 put together, you have the quadrilemma, not normally a dilemma, not a trilemma. We now have a quadrilemma, which means that the variables that are dealing with are probably more outside your control than within your control.
All right, Johnson, in dealing with this quadrilemma that Bismarck is talking about, I would like to get your thoughts on some quick fixes or low-hanging fruits that we can reach to. Bismarck was earlier alluding to the fact that we could look at productivity, but what are your thoughts?
Well, unfortunately, there are no quick fixes. There are certain things we need to do now, hoping that with the expectation that we should have the outcome will be positive in the near term or mid-term. Take, for instance, the issue of harmonizing the FX rate. Clearly, a lot of foreign portfolio investors are worried that if you do not harmonize the FX rate and eliminate the multiple exchange rates, that someday they're going to come in at this point, and when that exchange rate is harmonized, you're going to see a devaluation, and whatever gain they make from investing in your in your instruments, in your securities, will be lost from exchange rate devaluation. Secondly, we have about $2.5 billion of foreign portfolio investment that trapped in the country, according to the Bloomberg report. And if that figure is anything to go by, unless we adopt the policies to allow those funds to exit, you're not gonna, people who want to come in will not come in. If you have people's funds, if you have investors' funds trapped in your economy and they can't exit, then you are certainly not going to appeal to those who haven't come in. So clearly, central bank has to do something about that quickly. We need to allow further adjustment in the FX rate. We need to provide funding for those portfolio investors who have sold their instruments and want to exit, so that we can make it attractive for those who want to come in. So I think that's on what you may consider a relatively short-term approach to addressing the foreign exchange quagmire. Then you look at the issue of inflation rate. For me, my approach to inflation is that we need to determine what's our priority at this point in time. You really can't control all these macroeconomic variables at the same time. So if you think if the priority is to stimulate economic growth, it may come at the cost of higher inflation. So we should be ready to deal with high inflation, and once we improve productivity, then inflation rate could trend southwards. On the FX supply, it's going to come from we have three major sources of FX supply in the country. One, earnings from crude oil sales, which account for more than 80% of our foreign exchange earnings. Second is portfolio investments. And then third is inflows from diaspora remittances. Three of those major sources have been negatively affected. We are dealing with lower crude oil price. At the same time, we're dealing with low crude production. Then on foreign portfolio investment, I just mentioned the constraint, one of the limiting factors of foreign portfolio investment flow. Because if you have investors' fund trapped in your economy, nobody wants to come in. The third leg of it, which is diaspora remittance. Clearly, you see a lot of Nigerians that live outside the country are struggling to sustain their employment in those countries. So you don't expect to see a material increase in diaspora remittance. So in the meantime, the options are, can we access funding from loans? Can we access multilateral loans at relatively good rates? In terms of the Eurobond market is very difficult now for us to approach. So we must, if we have to access funding, we have already accessed funding from the IMF. We are trying to get funding from the World Bank. We also approach Africa Development Bank and Islamic Development Bank. So we need to drive those funding sources as long as they're coming to us at very friendly rates. So I think those are some of the, I wouldn't want to call them low-hanging fruits, but there are things we should do now. One other thing I've not mentioned is the issue of liberalizing the price of refined petroleum products. The NNPC MD and the government have been saying, the Minister of State for Petroleum have been saying they are liberalizing the price of fuel, but we know that the current price of fuel, the pump price of fuel, is not reflective of the international market price of crude or the price of flat. So they see some level of subsidy which we're not admitting. We need to, at this point, free up government resources from such not very productive investments or outlets or expenditure, so that whatever is available can be invested in critical sectors of the economy.
All right, then, Johnson, there's quite a lot to look at. Definitely, we'll keep our eyes on. I'm afraid that's all the time we have on this show today, but definitely thanks a lot for your contribution on the show. I've been speaking to Johnson Chukwu, the CEO of Carrier Asset Management, and also Bismarck Rewane, the CEO of Financial Derivatives. Up next, we'll get our conversation with the CEO of Tolerant Group, but that will come after the break. He'll tell us how the company is working to stay ahead despite the COVID-19 challenges. Power Lunch West Africa continues after the break.
Thinking of banking in Africa? Then think Zenith, adjudged the largest bank in Nigeria by Tier 1 Capital for 3 consecutive years, named Best Bank in Corporate Governance and the most customer-focused bank in Nigeria. Zenith is certified on 3 key ISO standards, a success built on dedication to people, technology, service and commitment to internationally accepted principles and standards. Zenith Bank, in your best interest.
It takes less than a minute to wear a mask, and even less to catch the COVID-19 virus. We are witnessing a surge in COVID-19 cases, with many lives being affected by a virus that has no respect for age, race, gender, religion, or status. But you can help stop the spread. Wear a mask, wash your hands always, and maintain social distancing. You just might be saving a life. My name is Abdul Samad Rabiu. Wear a mask, save lives.
Welcome back to Power Lunch West Africa. Now, since the 1970s, Tolaram Group has had business operations in Nigeria spanning from manufacturing to distribution of goods. As Nigeria's economy reels from the impact of the COVID-19 pandemic, the economy witnessed a 6.1% year-on-year contraction. And I have with me Pawan Sharma. He's the CEO of Tolaram Group West Africa, and he joins me to discuss the COVID-19 realities and how it's impacting the company. Thank you so much for your time on the show today, sir. And let's start with how you've been managed the COVID-19 pandemic across your business segments.
Thank you, Kenneth. So, as we know, since early this year, since pandemic has struck all our societies, businesses, not only in Nigeria, globally, everybody has impacted very severely. And while all of us are trying to struggle, come out from this, we are trying to implement our responsive strategies. So majorly, if I talk about our Nigeria business, we have twice hit, not only we, all the businesses. One is rock bottom crude oil prices, which has affected the currency in country. It has impacted the devaluation. It has impacted the inflation in the market. And at the same time, supply chain issues. We know that most of the local raw materials supplies have been impacted because of people movement is not as smooth as it should have been. At the same time, because of the high inflation and low consumer spending power, the demand has also impacted drastically. But being good thing for our business, like we are operating in West African market, South African market, and in North Africa also. Most of our business is basically necessary items, which are food items. So to keep the inflation low and to make sure that in this pandemic time, we were able to serve the food in every household, our teams work day in, day out. I would like to take this opportunity on your platform to thank all our employees in all the countries and all our my colleagues who were working on the front line, taking all the risks during this pandemic period and making sure that we are serving the daily food on every table. And though as a company, we have invested a lot in taking care of all the practices and providing safety gears to all our employees so that they are safe and sound.
All right, been quite an interesting year, definitely, but I can imagine starting talking about low economic activity across the board. We've seen that also play out in production and even in consumption. But I'd like to know, what is your outlook for the rest of the year?
So this year, the way we see businesses, because of all this scenario, profitability has impacted severely. So we don't look at this year to make profits. Margins are eroded. This year, major objective for all our businesses is how we take care of our employees, and at the same time, the communities we are working with. If we are able to keep their jobs and feed them regularly, and in terms of safety and hygiene, how we can take care of them. And going forward, I'm sure as a group, we have a lot of investments planned pre the pandemic period, and those investments are almost on track, though there have been delayed in deployment because of the lockdown situations. But we are very bullish about the economy, and those investments we will still do, and I'm sure the future is bright.
All right, very quickly, I'm still not talking about your investment, though I see you're doing quite a lot around the free trade zones and even walking around that deep sea port in Lekki.
Yeah, so in Lagos Lekki area, we have a free trade zone, which we are developing as an industrial hub. Is roughly 800 hectares of land where already 3 multinational companies are operating. So like you asked earlier, how the potential looks like. So as 3 multinationals are operating in that area, it means people and companies are still bullish about the Nigerian economy. And we are providing all the infrastructure facilities, warehousing facilities, power, and other facilities for other companies to come and operate and put their manufacturing plants in that area. And as deep sea port also being developed in the same vicinity, this is a incentive for all those manufacturing plants that they can have a lot of logistic advantages being there, which will bring down a lot of costs saving for them. And we know many other plants are all coming up in that area, like a fertilizer plant, petrochemical plant. So we see that area being a next industrial hub in next 3 to 5 years. And our investments are on track for those investments. Like, end of the March, when all of us going through this pandemic period, with one of our partners, which is Czech China Engineering Harbor Company, they invested $220 million in the deep sea port project, which is in conjunction with Lagos State and Nigerian port authorities also. So overall, all our partners, all our stakeholders, we are bullish about the coming time in Nigeria and how the economy is.
All right, then. Thank you so much for your time on Power Lunch West Africa today. I've been speaking to Pawan Shamar, he's the CEO of Tolaram Group West Africa. And that's a wrap on Power Lunch West Africa for today. And thank you so much for being a part of the show. From me and the team, enjoy the rest of your day.
Thinking of banking in Africa? Then think Zenith, adjudged the largest bank in Nigeria by Tier 1 Capital for 3 consecutive years, named Best Bank in Corporate Governance and the most customer-focused bank in Nigeria. Zenith is certified on 3 key ISO standards, a success built on dedication to people, technology, service and commitment to internationally accepted principles and standards. Zenith Bank, in your best interest.